If you want to understand the market, stop watching price charts. Stop listening to the noise. The real shift isn't on the screen, it's underneath. Most think markets move on headlines. That belief is comfortable, but wrong. This rally feels abrupt, like something snapping into place. It's not hype or fear, it's repricing. Assets are stopping to wait for permission. They're trying to escape. People aren't asking, is this bullish? They're asking, did that really just happen? If you've wondered why you missed signals before, this is one of those moments. Stay with me. Once you see the driver, you won't look at markets the same way again. Most people are being taught to look at this moment through the wrong window. Turn on financial news and you'll hear the same explanations recycled all day long. Markets are reacting to expectations. Investors are repositioning. It's just a rally. It's just a pullback. Those explanations sound smart, but they're shallow. They focus on movement, not cause. Here's the problem. When you explain everything as a reaction to headlines, you miss the structure underneath. And markets don't ultimately move because of opinions. They move because of constraints. Mainstream narratives treat gold and silver like trades. They talk about them the way they talk about stocks, entry points, resistance levels, sentiment. But that framing collapses when the system itself starts straining. What's happening now isn't about people suddenly liking metals more. It's about confidence quietly eroding in the assets that are supposed to be boring, safe, and unquestioned. Most coverage asks, where will prices go next? That's the wrong question. The real question is, what is the system trying to adjust for? When large, slow-moving markets begin to act jumpy? When long-term assumptions stop holding? When assets tied to trust and credibility start behaving differently? That's not speculation. That's adaptation. And here's the key reframing. Gold and silver aren't leading this shift. They're responding to it. They're acting like sensors, not drivers. Once you stop thinking in terms of trades and start thinking in terms of pressure in debt, pressure in currencies, pressure in confidence, the recent moves stop looking random. They start looking inevitable. Let's slow this down and ground it in reality. Strip away opinions, predictions, and social media noise and focus only on what can be verified. First, start with precious metals demand and supply. Over the last several years, global silver demand has consistently exceeded new supply. Industry estimates place total annual silver demand in the neighborhood of 1.1 to 1.2 billion ounces, while mine supply plus recycling has struggled to keep pace. This imbalance has resulted in structural deficits, meaning inventories have been drawn down rather than rebuilt. A significant portion of silver demand now comes from industrial use, not investment speculation. Electronics, electrical components, medical applications, and energy infrastructure all require silver's conductivity and durability. The solar industry alone has become one of the largest single sources of silver consumption, using a meaningful share of annual output. While manufacturers work to reduce silver content per unit, total installations have continued to grow, keeping overall demand elevated. Second, look at gold behavior. Central banks around the world have remained net buyers of gold in recent years. Public data from international institutions shows sustained accumulation, not by retail investors, but by monetary authorities. This behavior is typically associated with reserve diversification and long-term risk management, not short-term speculation. Third, examine the bond market, particularly long-term government debt. In the United States, yields on long-dated Treasury bonds have remained elevated and volatile compared to the post-2008 era. Similar patterns have appeared in other developed economies. Rising yields reflect falling bond prices, which in turn indicate stress in the market for government financing. At the same time, government deficits remain large. Public budget data shows persistent shortfalls between spending and revenue, with interest costs becoming a growing component of total expenditures. Servicing existing debt has become more expensive as rates rose from historic lows. Fourth, consider currency dynamics. Periods of higher volatility in bond markets and growing debt burdens often coincide with questions about long-term purchasing power. Currency markets don't always react immediately, but they tend to reflect these pressures over time through fluctuations and reduced confidence. None of these facts, on their own, predict a specific outcome, but together, they describe a system under strain. Demand outpacing supply in key materials. Large-scale institutions quietly hedging risk debt market. When you step back and look at these facts together, a pattern begins to form. Not a prediction, a direction of pressure. One possible interpretation is that the system is adjusting to limits it can no longer ignore. Debt levels are high, servicing costs are rising, and the tools that once stabilized markets, near-zero rates and unlimited liquidity, carry heavier side effects than they used to. From a strategic perspective, this suggests policymakers may face narrowing options. If long-term interest rates remain elevated, governments must either accept higher financing costs or intervene to stabilize bond markets. Historically, intervention has often taken the form of liquidity support, rate cuts, asset purchases, or other mechanisms designed to reduce stress. That approach may calm markets in the short term, but it can also signal that monetary discipline is being relaxed to protect the system. From the perspective of large institutions, this may help explain continued interest in assets that do not rely on a counterparty's promise. Gold, in particular, functions as a reserve asset precisely because it sits outside the credit system. Silver, while more volatile, often follows when confidence shifts from abstract claims to tangible value. Another strategic implication involves who benefits and who absorbs the cost. When currency purchasing power weakens, borrowers tend to benefit while savers lose. Governments with large debt loads gain flexibility, while households holding cash see their real value erode over time. Asset owners often adjust more quickly than wage earners, widening the gap between financial markets and everyday experience. There is also a geopolitical dimension. Reserve diversification by central banks may indicate a desire to reduce exposure to any single currency system. This doesn't require coordination or conflict. It can simply reflect prudent risk management in an uncertain environment. Importantly, none of this requires panic or collapse. A system can remain functional while quietly changing its internal balance. Prices can adjust upward not because demand explodes, but because the unit of measurement, the currency, carries less weight. From this lens, movements in precious metals may not be leading indicators of fear, but lagging indicators of adjustment. They reflect decisions already made within the system rather than emotions still forming among the public. The strategic takeaway is not that one asset must win, but that power flows toward flexibility. Assets that are difficult to debase or replicate tend to regain relevance when policy constraints tighten. This doesn't guarantee extreme outcomes, but it does suggest that recent market behavior is not random. It's responsive. When pressure builds inside a financial system, it rarely stays contained. It spreads, sometimes quietly, sometimes suddenly, across markets, institutions, and borders. One potential consequence of sustained bond market stress is increased fragility in the banking system. Government bonds are widely used as collateral. When their prices fluctuate sharply, balance sheets become harder to manage. This doesn't automatically trigger a crisis, but it does raise sensitivity. Small shocks can have outsized effects. Currency dynamics are another area of impact. When governments rely more heavily on monetary support to manage debt, confidence in long-term purchasing power can soften. This doesn't always show up as immediate inflation. Often, it appears first as volatility, faster moves, wider ranges, and less predictability in exchange rates. Over time, this can influence global capital flows. Investors may favor jurisdictions perceived as more stable or assets perceived as less exposed to policy risk. That shift doesn't require consensus, it happens trade by trade. Governments, meanwhile, face difficult trade-offs. Maintaining financial stability, funding public programs, and controlling inflation are not always compatible goals. Choosing one often stresses the others. As a result, policy decisions can become reactive rather than strategic, responding to immediate pressures rather than long-term planning. On a global level, these dynamics can alter the balance of economic influence. Countries with stronger balance sheets and access to real resources may gain leverage. Those dependent on continuous borrowing face greater scrutiny. Reserve assets and settlement mechanisms may gradually evolve as participants seek resilience rather than efficiency. This is how systems change, not overnight and not through a single announcement, but through accumulated responses to constraint. Precious metals fit into this picture not as a solution, but as a signal. Their movement reflects shifting confidence across the system. They respond to the same pressures affecting bonds, currencies, and policy decisions. The key consequence to understand is this. When trust-based systems are stressed, assets anchored in physical reality tend to reassert relevance. That doesn't mean everything else fails. It means the hierarchy adjusts, and when hierarchies adjust, the effects ripple far beyond charts and portfolios. All of this can sound distant if it stays at the level of markets and policy, so let's translate it into real life. For most people in the United States, the system doesn't feel broken because it still functions day to day. Paychecks clear, stores are stocked, bills get paid. That's how slow-moving shifts work. They don't announce themselves. But the pressure shows up in subtler ways. Savings don't stretch as far as they used to. Long-term planning feels harder. The cost of essentials rises faster than comfort levels, and the idea of playing it safe starts to feel less certain. When bond markets are stressed and governments run persistent deficits, the effects often land on households indirectly. Low-risk savings vehicles may struggle to keep up with purchasing power. Retirement planning becomes more complex as traditional assumptions about stability are tested. For workers, this environment can influence job security in uneven ways. Companies tied closely to financing conditions, construction, manufacturing, capital-intensive industries, may feel pressure sooner. Other sectors may lag, creating a sense that the economy is sending mixed signals. Cost of living is where most people feel it first. Energy prices, food, insurance, healthcare, these are not abstract categories. They are monthly decisions. When currency purchasing power erodes gradually, families adapt without always realizing why the adjustments are necessary. This is also why asset prices and everyday experience can feel disconnected. Markets often move first, wages adjust later, if at all. That gap creates frustration and confusion, not because people misunderstand economics, but because the transmission is uneven. The purpose of understanding these dynamics isn't fear, it's orientation. When you recognize that certain pressures are structural, not personal failures or bad luck, you can think more clearly about choices. How much risk to take, how much flexibility to preserve, how dependent your future is on a single assumption continuing to hold. This is where awareness becomes practical. I call it the structural pressure lens. Instead of asking, what is the market doing? Ask, where is pressure building? Systems fail where pressure accumulates. Focus on 3 questions. First, where is leverage highest? Think excessive debt and tight margins. Second, where is flexibility lowest? Rigid obligations break when conditions change. Third, where is trust doing the most work? When trust breaks, even minor disruptions trigger outsized reactions. Asset prices are just signals. This framework tells you what to watch. Because over time, momentum fades, but pressure eventually resolves. Stop reacting to noise. Start observing structure. So how do you actually use this way of thinking without turning it into speculation or stress? Start by separating preparation from prediction. Preparation means positioning your life so you're not forced into bad decisions when conditions change. It's about reducing fragility, not trying to outsmart markets. First, pay attention to liquidity and flexibility in your own finances. That means understanding how much of your future depends on one income stream, one employer, or one assumption continuing unchanged. Flexibility gives you time. Time is the most valuable asset in uncertain environments. Second, observe signals instead of prices. Instead of watching daily charts, watch behavior. Are policymakers emphasizing stability more than growth? Are institutions quietly hedging rather than promoting optimism? Are long-term assumptions being revised instead of reaffirmed? These shifts usually happen before the public narrative changes. Third, think in ranges, not outcomes. Ask yourself, if conditions improve, what does that mean for me? If conditions stagnate, what changes? If conditions deteriorate, where am I exposed? This mindset reduces emotional decision making because you're not betting on a single future. Fourth, avoid the trap of urgency. Periods of structural change create pressure to act quickly, but rushed decisions often lock in mistakes. Calm observation combined with gradual adjustment tends to outperform dramatic moves over time. Finally, invest in understanding, not certainty. Certainty is fragile. Understanding compounds. When you understand how systems respond to pressure, you're less likely to be surprised, even if outcomes differ from expectations. This isn't about being bullish or bearish, it's about being resilient. Resilience doesn't require perfect foresight. It requires awareness, patience, and the willingness to adapt as reality unfolds. If there's one idea to take with you, it's this. Markets don't change direction because people suddenly panic. They change because pressure finally outweighs flexibility. By the time headlines catch up, the adjustment is already underway. What you're seeing right now isn't something to fear, and it's not something to chase. It's a reminder that systems evolve quietly until they can't, and then they adjust all at once. Understanding that doesn't give you certainty, it gives you perspective. And perspective is what allows you to move through uncertainty without being pushed around by it. You don't need to predict the future to prepare for it. You just need to recognize where assumptions are being tested and where trust is doing heavy lifting. When you watch markets through that lens, price moves stop feeling random. They start feeling like messages, not instructions, messages. Stay observant, stay patient. And remember, the goal isn't to win the moment, it's to stay positioned for whatever comes next.